1974, Boston. Jack Bogle is being thrown out of his own company as Wall Street executives orchestrate a boardroom coup, unaware they've just made a $12 trillion mistake. Because while they were plotting his exit, he figured out how to use Wall Street's own rules to take the profit for himself and away from the industry. He isn't just starting a new company, he's starting a rebellion. He names it Vanguard. His mission? To rob the rich fund managers of their fees and give that wealth back to the poor individual investor. The establishment laughed. They called his idea un-American. But today, Vanguard manages over $12 trillion, holding the keys to nearly every major corporation on Earth. So how did a boardroom defeat become a $12 trillion revolution that brought Wall Street to its knees? And what math were Wall Street giants too greedy to see? 1949. Jack Bogle just turned 20. While his classmates are busy chasing girls or securing careers at IBM, Jack is digging into the big money in Boston. He finds a mutual fund industry that is essentially a legalized racket. $2 billion in assets managed by men in pinstripe suits who take a cut of everything, win or lose. The system is built on a lie that these experts can beat the market. Jack starts running the numbers and the math doesn't lie. His senior thesis isn't just a paper, it's a declaration of war. His conclusion is a middle finger to the entire establishment. The managers are the problem. Math is the solution. For 20 years, he worked from the inside, like a sleeper cell in the Wellington Fund, where Wall Street giants didn't sell growth, they sold access. And under the hood are tiny frictions: fees, loads, trading, marketing. Each is invisible. Compounded over decades, they're lethal, devouring not just profits, but the principle itself. He watches the pros gamble with other people's lives and lose. The industry's logic was, the more you trade, the more you justify your fee. So what happens when he confronts his senior executives? Why did he get fired? In 1974, Bogle was fired from his own firm after poor short-term performance. But the real reason ran deeper. He believed fund managers couldn't beat the market and that high fees were hurting investors. That idea attacked the core business of active management. So the establishment legally blocked him from picking stocks, setting strategy, or managing a single cent of public money. They left him only the scraps, the boring paperwork and behind-the-scenes operations of mutual funds. They think they've put him in a cage. They've actually given him the keys to the armory. Because the funds are owned by the investors, not the managers, Bogle can't pick stocks, but he can choose who gets paid. And that's the loophole. He does something no one on Wall Street even considers. He moves all the work inside the fund itself. Instead of paying an outside company to run things, the fund hires its own employees and runs everything internally. That cuts out the middleman and the profits that middleman was taking. That money now stays with the investors. He calls this setup Vanguard. There are no outside owners, no rich bosses asking for profits every few months. Vanguard is owned by the funds themselves. It exists for one reason only: to cover basic costs and nothing more. To Wall Street, this looks insane. It's not flashy, it's not clever, it's just boring admin work and cleanup, which is exactly why they miss how dangerous it really is. To his competitors, it's a joke. To match his prices, they would have to fire themselves and give up their Ferraris. They don't realize Bogle's new client-owned structure for Vanguard created an unprecedented, permanent competitive advantage. Every dollar he saves in fees doesn't go to a marketing budget. It goes directly into the investor's return. Lower costs lead to better returns. Better returns attract more capital. More capital lowers the costs even further. It's not a product. It's a virus designed to starve the middlemen. For now, the big banks are laughing. They're too busy fighting each other for the next hot stock to notice that Jack Bogle has stopped competing entirely. He isn't trying to beat them at their game. He's making the game obsolete. The industry is quiet. The alarms aren't sounding yet. The moment scale enters the picture, this quiet structural advantage isn't going to look like efficiency anymore. It's going to look like a massacre. Will Bogle's mathematical certainty hold up against the raw power of the financial establishment? And what happens when the sharks decide to bite back at the man trying to starve them? For a decade, Wall Street treated Vanguard like an accounting glitch. No star managers in $5,000 suits. No bold forecasts on CNBC. To the titans of finance, if you aren't showing power, you aren't playing. They assume Bogle is dying in the dark. They're wrong. By the late 70s, after fees are stripped away, Vanguard is sitting at the top of the mountain, year after year, bull market or bear. The boring index fund is beating the geniuses at their own game. This is where the threat becomes clear. Investors realize they don't need a hero manager if the market itself delivers better results for pennies on the dollar. The executives at the big firms know if this logic spreads, their profit margins will go up in flames. But they are trapped. They can't copy Bogle. Their companies are owned by greedy shareholders. Their revenue depends on those fat fees. So they grab the only weapon they have left: mockery. The index fund is branded as Bogle's Folly. They claim capitalism depends on winners and losers, and that owning everything is a worship of mediocrity. They try to frame indexing as lazy and unpatriotic. They know if they can make the math look intellectually inferior, they don't have to debate the numbers. So when Vanguard launched their first retail index fund in 1976, Bogle hoped to raise $150 million. He raised just $11 million instead. It's a disaster. Wall Street laughs. They think the folly is dead, but they missed the data underneath. The investors who bought in, they aren't leaving. They aren't trading. They are holding the line. And as they stay, their returns begin to compound. By the mid-80s, the laughter stopped. Massive studies prove the truth Bogle lived for. Most active managers aren't incompetent. They're just too expensive to win. The big firms double down on the noise. More marketing, more complex black box products. If they can't beat the market, they'll sell the feeling of beating it. They fight for attention while Bogle fights for outcomes. Inside Vanguard, Bogle knows the industry isn't angry because he's wrong. They're angry because he's irreversible. David is no longer a nuisance. He's a structural flaw in the Goliath of finance that cannot be patched. And when the establishment realizes they can't compete on design, they turn to force. If the model can't be stopped in the market, the next move is to challenge whether it should be allowed to exist at all. Will the titans of the old world find a legal way to kill the machine before it starves them out? Pension funds and individual investors start realizing that the 1% they're losing to experts is actually a fortune being stolen from their future. The industry highlights the rare years when a celebrity manager beats the index. Bogle's response? Silence, and he just lowers fees again. This is survival engineering. Every time assets grow, costs fall. Every time costs fall, Vanguard becomes more lethal. Internally, the company hardens into a fortress of efficiency. No prestige offices, no executive bloat, no bonuses for taking reckless risks. Anything that doesn't add a dollar to the investor's pocket is stripped out with surgical precision. The big banks are trapped in a cannibal's dilemma. They try launching their own index funds, but they keep the fees high to protect their fat profit margins. They try to bundle indexing into complex, expensive products, but they can't fully commit without destroying their own business model. By the 90s, the Vanguard had become a force of nature. At the center of it all, Jack Bogle's role shrinks even as his shadow grows. He isn't trading or forecasting. He spends his time fighting off complexity, ensuring the machine stays pure. But here's the terrifying truth for the establishment. The system doesn't need Jack Bogle anymore. The architecture is self-sustaining. The ownership structure is locked. Brute force fails because there is nothing to overpower. You can't starve a ghost that doesn't eat profit. By the time the industry understands what this structure has become, the question is no longer whether Vanguard will survive, but what it now controls. As the trillions begin to shift, is the world ready for a market where the passive players hold all the cards? By the early 2000s, Vanguard wasn't an experiment anymore. It's basic infrastructure, the hidden pipes under global finance. Trillions of dollars now flow through a system that doesn't try to be smart, doesn't promise to beat the market, and doesn't care how you feel about it. Bogle's rebellion has won so completely that it has become the new establishment. This is an irreversible change. Vanguard proved that at scale, high-priced active management isn't just a bad deal, it's unnecessary. Across the world, fees collapse and never recover. Entire business models built on permanent fees quietly bleed out and die. But as the price of investing hits the floor, something else rises to the ceiling: massive concentration. Vanguard doesn't pick winners. It owns every major public company, sector, and index. The same boring fund now appears on the shareholder registry of every competing firm on the Fortune 500. A firm designed to strip power from intermediaries has become the most powerful intermediary in human history, not through greed, but through structure. It's not a conspiracy. It's a side effect of winning. Vanguard doesn't lobby like a bank. It doesn't trade like a shark, but its sheer scale creates its own gravity. Proxy votes, boardroom standards, corporate governance, the quiet ability to shape the world's economy without ever firing a shot. Even Bogle, in his final years, grows uneasy. He sees the contradiction. If everyone becomes a passive passenger, who is left to drive the bus? Who is left to question the valuations when everyone is just buying the index? He watches as the low-cost tools he built for patience are used for speed, as ETFs turn his battleship into a fleet of fighter jets. This is the cost of winning a structural war, as the safe idea has grown so large that it has absorbed the market itself. Trillions have been saved. Access once reserved for the ultra-elite is now in the pocket of anyone with a smartphone. When everyone owns everything, who is actually responsible? Vanguard doesn't care about the debate. It just keeps growing, quietly, relentlessly. It is now a background assumption of modern life, so deeply embedded that we've stopped noticing it's there. The old order is gone. The fees are never coming back. The sharks have been starved.